It's not about timing the market. It's about time in the market. So I would say forget about in and out of the market and bubbles and just put a plan in place and just block out the noise.
As a disclaimer, the opinions stated on this podcast are of the analysts and the guests and do not represent BLK or its sponsors. Hello and welcome to the BLK Podcast. My name is EOL Castledarge. I am a research equity analyst at BLK. With me today is Amine, and she will introduce our guests.
Hey everyone, like you said, I'm Amine Daly. I'm a junior at Georgetown University and an equity analyst researcher at BLK. I'm super excited to be introducing our guest, Gerry O'Reilly, Vanguard. Mr. O'Reilly has been working with Vanguard for almost 30 years and is a portfolio manager there. So really excited to be.
Great. Well, thank you both very much for inviting me on. I'm looking forward to the discussion. So let's hope it's a good, informative next hour or whatever we have together. Looking forward to it.
Yeah. Thank you so much for joining us today. Just to give the listeners kind of a background about yourself, where did your interest in finance begin, and how did you get to the position to where you are today?
Sure. Yeah. Well, it happened with me probably a little later in life. I actually grew up in Ireland and came over to the U.S. A university that you might know a little bit about. I went to Villanova University, so there's a little bit of a rivalry there.
A little bit. I remember seeing that basketball.
Yeah. So I came over on a track scholarship to Villanova, and like any freshman, I thought I wanted to study business, but I didn't know within the business field what area I wanted to get into. And I just had after going through a couple of economics classes, it got to a point where I just had a comfort level with some of the teachers I had. I kind of understood when they would be, doing their graphs, how this whole thing kind of worked. So I kind of decided that economics was the way I wanted to go. I knew for sure I didn't want to do accounting. That was one certainty. And just economics kind of made more sense to me. I enjoyed reading about it. I enjoyed kind of, understanding it. And so that's kind of what got me into, economics. And then I would say finance, it wasn't until I started working at Vanguard and applied for a position as an assistant trader that I fully knew that, this is something I could see myself doing for the next 25, 30 years. I felt like the dynamics of trading just got my juices going. And as someone who was an athlete, a lot of the kind of adrenaline rushes you would get when you were competing, I found I got the same kind of sensations when I was working on a trading desk. There were incredible wins and there were disappointments, and you had to get over the disappointments quick. And so I just felt like this is something I love to do and I had great passion for. So I would say, it wasn't until I got to Vanguard and started working on the desk that I really felt like this is my calling.
Sorry to hear about the Villanova. I think Georgetown would have been a better choice, but it's okay.
Hey, my daughter is just finishing up her master's at Georgetown, so I've got feet in both camps.
Oh, awesome! What program, if you don't mind me asking?
She's doing her master's in marketing, and she's going to graduate in a month. So we have Hoya memorabilia in this house too, not just Villanova Wildcat stuff.
Love it. Love to do it.
Wow.
So I'm wondering now. So after you took this journey and you saw that you took this same competitive position on the trading desk, what brought you to Vanguard?
So Vanguard just happened to be so one of the people that I used to run against, a guy named Jim Norris. Jim happened to work at Vanguard, and so you're in your early 20s, you're kind of trying to figure out where you want to work. And he was like, "Hey, I work for this company, Vanguard," which at the time I knew very little about. And he said, "Would you want me to drop your resume off?" So that's kind of how I started, at Vanguard. It wasn't like I moved, to another state. It just happened to be a company that had its offices were, 20 minutes, half hour from where I lived in outside Philadelphia. So I interviewed there, and I knew very little about the company. I was like anyone starting out in their career. I start scrambling the week before my interview to figure out. Let me find out what I can about this company Vanguard, and of course learned about passive investing. Learned about Mr. Bogle, Mr. Brennan, who was kind of senior here at the time. Kind of learned about just about what they offered, what services they offered, what mutual funds, and then I went and interviewed, and fortunately I got the position. So my initial position was just an entry level type phone position. So it was actually a good way to learn about what Vanguard offered and what. So you got to kind of whoever called, they might be looking for a prospectus, they might be looking for IRA information, they might be looking for tax information. So it was a good way to kind of learn the business. So I kind of did that for a couple of years. And then I applied for a position on the trading desk after maybe 2.5 years, and was fortunate enough to get accepted. And at that point, we were relatively small. We had maybe 30 billion in assets and about 20, 25 funds at the time. And it was a relatively small group of people, maybe 10, 12 people. Today we're up to 4 trillion in assets on the desk. And 24 people here in the U.S. And then in the UK we have about 15 or so traders, and then in Australia about the same. So it's a much bigger operation today. So that's kind of how I ended up at Vanguard, but it's come a long way from the Vanguard that I started with today. Yeah.
Wow. Yeah. And I feel like that's something Vanguard loves to talk about as well, how they have that insane amount of assets under management. 4 trillion is a lot.
Well, 4 trillion is just what we manage on our desk. Our total assets for Vanguard are actually over 7 trillion right now. So it is a big number. Yeah, it's a big number. But it has never been the goal. I'll be honest. It's always been like, hey, let's try and offer world class kind of products for shareholders. Mutual funds and ETFs, and the assets are just that's just the results of what you're offering to clients, that they're buying into it. And so Vanguard's philosophy of low cost diversified funds has managed to attract the attention of a lot of investors. So that's why 25 million or so investors today invest with Vanguard.
Exactly. So you spending a long career at Vanguard, how have you personally seen the exponential growth of the company, the firm? As it's raising more assets, like how does the company change?
Yeah, well, I mean, the good thing is that there are certain aspects of the company, obviously, that have changed. I mean, the number of employees is has blown. We've gone from a couple of thousand people when I started to probably today in excess of 16,000 people, and we've gone from just having a presence here in Malvern, Pennsylvania, to now having offices in the U.S. in still in Malvern, but also in Scottsdale and Charlotte, as well as internationally, UK, Australia, and then some offices even further afield. So the footprint is bigger, but a lot of the, I would say a lot of the beliefs are what they were when I started, like in terms of our philosophy about investing, we're, investing for the long term, the importance of costs, how costs play into the whole equation, and, how passive investing is just a very powerful way for people to meet their goals, whether they are, saving, for a house, whether it's putting kids through college, whether it's for retirement, whatever the case may be. So those things have changed the same. But I think just, when I look at Vanguard today, we started off, there were 2 or 3 buildings when I started off, and now we have this huge campus, and just the footprint is bigger. But a lot of the core beliefs are very, very similar. Like I remember from very early on, it was always like, hey, our compass should always be, let's do what's in the right interest of clients. And that's still the case today.
That's really cool.
Yeah.
Yeah, that's really great to hear. So I hear you starting to talk about, how the investing mindset and the target audience kind of changed over time. So can you talk a little bit more about what that Vanguard mindset of investing means to you?
Sure. So, it's funny because it really was kind of brought home to me earlier on this year when we had all of this activity around retail stocks, Gamestop, and all these names back in January and February. And I knew it was something was different when I had my younger sons asking me about it. How do you open an account so you can trade? Because all their friends were interested in trading the GameStops, and I was trying to explain to them that is not investing, right? That is, to me, that is kind of gambling with stocks. So this in and out of stocks in the course of a day. So that is the absolute antithesis to what Vanguard is about. So Vanguard, in terms of our philosophy, it's, we think about 5-year, 10-year, 20-year time horizons in terms of investing, right? Putting money away, like you guys, you're young in college now. You probably think I'm never going to be retired, but you are going to be retired at some point. And so, putting money away, like as soon as you guys start to work, the importance of compounding and getting money into your, whether it's 403Bs or 401Ks, whatever it might be, you'd be amazed that if you have time on your side and you have 20, 30 years of compounding, even 6%, 7% returns compounded is going to make a massive difference down the road. So Vanguard definitely has this sense of hey, if you're investing, you shouldn't be thinking about investing for 6 months. Forget about investing for a day, like some of the folks who were involved in GameStop. You should be thinking really long term. And then the question is, what should you be investing in? And obviously, huge fans of passive investing, indexing, because of the benefits of it, which are diversification, low cost, low turnover, and just the fact that passive investing funds tend to outperform over the long term. So when you are outperforming 80% of your peers, that's probably not a bad, to be on that side of the equation is a good thing. And there are occasionally active managers who will outperform the benchmark, but there are very, very few who will do it consistently over a number of years. So if you can get the return of the benchmark, you're going to do better than most investors over time, especially when you factor in, the fact that, our average expense ratio is about 10 basis points at Vanguard. And some of the funds, the largest fund I have, Total Stock Market, has an expense ratio of 4 basis points. So that's pretty low. And, if you think about it, for 4 basis points, you can get the return of the Total Crisp Index Fund. And in fact, we've been able to even eat into that 4 basis points expense ratio. So what investors have been getting has been even more than that. So we've been able to eat into that expense ratio a little bit. So if you can get low cost, good diversification, I think that's a good way to invest for some of your long-term goals. Yeah.
So I'm always calling from Las Vegas. So I assume I won't be finding Vanguard on the strip.
No, probably not. No, I don't think. Although I will say that there are some of the traders on the desk who once in a while, when things are normal, like NCAA basketball and things like that, they have been known to maybe go out there for a few days during March Madness. But from an investment point of view, yeah, very different to that mindset.
Okay.
Yeah, definitely. And I feel like you're describing it very explicitly. But what is the Vanguard mindset of investing?
Yeah, so I think first of all it would be, hey, you have to think long term, right? You have to think, for investing, you want to be thinking multiple years down the road. But then, the question comes, well, what should you be investing in? And we're huge fans of, low cost, diversified, either mutual funds or ETFs. And, most of the funds that we offer, if you think about it, before we launch an ETF, for example, it has to pass certain criteria. And things that we look at are, is there investment merit in the strategy that we're looking at? Are investors looking for this type of exposure? And can we offer a world-class product? And are we able to do it at a low-cost option? So if we can answer yes to all of those, there's a good chance that we're going to launch an ETF or a mutual fund. And that's kind of why it's been a kind of steady as it goes type process here. So you're not going to see Vanguard, I think, offering a lot of kind of fad type ETFs that are just happen to be cool at the moment. If it doesn't have investment merit, the likelihood is that we're not going to offer it. So it's just, it is a little boring if you think about it. Hey, low cost, diversified funds. It doesn't sound super exciting, but over time, that has been a phenomenal way for people to invest. And so that's what we encourage. And it's been good because even, I would say, back in March when things got really rocky with the markets, in March of 2020, when volatility, in the market, dropped like, 30-40%, most Vanguard investors stuck with their investments. And so that's a great thing because there would be nothing worse than you can imagine an investor getting out back in March of 2020. They missed 80-90% on the upside if they stuck with it. So the importance kind of just staying with it, even blocking out the noise, not listening too much to what commentators are saying is really important. So I think that's part of what the Vanguard philosophy is as well, to think really long term. Yeah,
definitely. I feel like it's a really unique way of looking at it because, I feel like some firms look at, high risk, high volatility trading as more something that's more sexy compared to, the consistent 6% yearly growth.
And I mean, the market has been, 6% would be super conservative, but if we look, over the next 10 years from where we are right now, I think Vanguard for U.S. domestic, we think like maybe 5% on the international side, just because you're not starting from such a high level. I think maybe the returns we would expect a little higher than that. But, the market has delivered incredible returns over the last, 10, 15 years, like north of 10%. So it's been really good to be an equity investor in this country. Yeah.
Yeah. And I just wanted to briefly mention, I believe I was listening to like a Warren Buffett speech, and he was talking about like the consistency of the market, and he made a wager with a select group of investors, and I think it was, if you can beat the market for like 5 or something years, I'll give you like $1 million, or if I just put this money towards an ETF fund. And I think towards the end of that wager, it was quite obvious that Warren was going to win, even after the 2008 financial crisis.
And the great part of that wager was that it was the equity fund that he picked was the Vanguard Index 500 fund.
Exactly.
So that was a nice little slap on the back. So Don Butler, who runs that fund for us, I think he was pretty proud to hear that. That was the fund that he picked. And I think it was a hedge fund manager who so the 500 fund basically outperformed, and I think the $1 million was the bet. Yeah. But it is difficult to do. When you think about an active manager, for example, if I look at VTI, which is the ETF that associated with total stock market, which is the largest fund we have at Vanguard, the expense ratio, as I mentioned earlier, is 4 basis points. The turnover in the fund tends to be less than 10% on an annualized basis. So turnover, if you think about it, is the lesser of buys and sell over the course of the year divided by the average assets. The average active fund tends to have turnover in the, north of 50, 60%. So turnover is basically, the costs associated with trading, they definitely are a headwind when it comes to performance. So if you can have a passive investment with a low expense ratio and low turnover, those are massive hurdles that an active manager needs to overcome in order to get ahead of you. So we've been, those are the types of funds, those low-cost index funds with low turnover are the types of funds that we offer. So they've been a great vehicle for investments over time. Yeah, for sure.
Yeah, definitely. I'm so glad you brought up the ETI too, because we wanted to ask you about, how you think everyone, like your everyday average investor down to your, college students, how everyone should be looking at these ETFs and VTIs, especially, having been entranced with the sexy looks of Gamestop clippings or other temptations toward active investing. So why, when we look at it, say, young individuals starting out in investing, when we look at the ETFs, it seems almost like, maybe that's something I'll do down the line. Or maybe right now I have a little bit more risk tolerance. I should do a little more risky stuff. But I think it's important to still hone in on ETFs and looking at the VTI. So can you go into a little bit more about that, like how what advice?
Sure. So the advice I would give would be to start. That is the most important. Just get started. Even if it's just a small amount of money, just get started. And especially when you have the advantage of age, being such young people, if you can just, hey, let's put a little money away. And then if you can, even better if you can get an automatic investment plan. So it's, whether it's every month or every quarter, you can put some money away. Phenomenal way to start. And then, I would say with regard to VTI, if you're looking, VTI basically is almost like a proxy for the entire U.S. stock market. So it's a combination of large cap, small cap, and mid cap. So if you just want, hey, I just want U.S. equity exposure, but I don't want to be worrying about large cap, and then I have to buy a small cap fund and maybe a mid cap. If you just want, I just want U.S. equity exposure, VTI is going to give you that. So the mutual fund itself has about 3,600 securities, and no surprise, the biggest names in there are going to be Apple, Amazon, Microsoft, names like that. But then there are names down, when you get down to the bottom below kind of 3,000, that are names probably very, very, wouldn't be well-known names at all. But those are the names that are going to give you that kind of small cap and mid cap type of exposure. So, over time, I would say, if you just want to keep it simple and I just want U.S. equity exposure, VTI is going to give you that. And, when you get, you can get that exposure for very, very low cost. It's 4 basis points for the Admiral share class. So it's able to give you that. And I would say the most important thing is to just start. And then you will see over time kind of the power of compounding. And to the extent, if there are areas of the market that you feel like, hey, I'm young, I can afford to take a little bit of a fly with something, maybe on the margins, that's what you can do. But I would say as your core holding, I think it would make sense to consider something like VTI as like, this is kind of going to be the one that is going to be the kind of the engine to my investment success. But, maybe I decide I want to add a little small cap value down the road or something over in whatever area that you feel like, hey, I'd like some exposure to this area, whether it's maybe something along ESG lines or something like that. I think if you think in that mindset, I think you're going to do quite well down the road.
Yeah, definitely. I just want to point out, I started investing when I was like 16 years old. I opened an account under my mom's name, and she let me use my own money to invest. And the first 2 stocks or ETFs that were in my portfolio were the Vanguard S&P 500 and the VTI. So I just as you start investing, I think this is such a great way to get started, and it gives you such good exposure to the market as well.
Yeah. I mean, Mr. Bogle, who founded Vanguard, he used to, people used to always say, well, I much prefer just going with individual stocks. And he had an old saying, it was like, why look for the needle in the haystack when you can buy the whole haystack, right? So when you buy total stock market, you're buying the whole haystack. You're buying everything, basically, in the U.S., right? So it gives you incredible diversification at low cost. And it's just, it's a fund that's it's grown so much over the years. And I think it's just because investors, they really understand that, hey, if I can get low diversification, or if I can get a lot of diversification, I should say, at low cost, that's a pretty good investment for me. So, great to hear that you've been in it that long. I'm sure it's grown a little since then.
Yeah.
And so that's a great way to start. And at 16 is fantastic. That's great that your mom allowed you to do that.
Yeah. Thank you, Mom.
Yeah.
Yeah. So there's a lot of other people who are starting, or other firms to say, who are starting to create ETFs. Like, for example, Kathy Wood in Art Finance.
Sure.
These are more aggressive, innovative ETFs. But there's several out there as well. Like, I'm trying to think. I can't think off the top of my head what the others were, but there's other firms that are making these ETFs. How did Vanguard become so popular to the everyday American? How did the VTI and the VOO become household ETFs?
Sure. Well, it wasn't always that way. I would say back in the early days when these funds, I mean, we're always coming up on 20-year anniversary for when VTI started trading. But I remember, in the early days when Gus Sauter, who ran our group, coming into the trading room just to see what kind of volume was on the tape, and like high fives were going up when it traded like 25,000 shares, on a day. So that was, and now it trades in the millions and millions of shares every day. So it wasn't, but I think it was just, hey, if you can, it's like I mentioned earlier, if what you're offering has investment merit, and we have teams at Vanguard that study that. So we have a portfolio review team that kind of looks at this in terms of, new products that we're thinking about. And we have a lot of fantastic researchers that work on areas like that. And, if you think that, hey, is this something that investors, we think is going to, that investors are looking for this type of exposure, whatever it might be. And are we going to be able to offer a world-class product in this? And can we do it at low cost? If we can kind of check the box on all four of those, then this is going to be something that probably Vanguard would be interested in. If we think it's a fad, like back in 2000, in 2000 when internet was just going nuts, I'm thinking of your ages. You probably were not even born, but people wanted anything that had .com on it, and they wanted internet funds that just, all we're going to invest in is something that has .com in it. And, that's not something we would ever consider. We would say, hey, there's really no investment merit to that. But back then there was tons of, funds that were kind of, they lasted for a few years and then probably went belly up. So I think, Vanguard, as I mentioned, if it's got investment merit, we can do it at a low cost, and it's going to, we think it's going to work with investors, then we're going to consider doing it. So I think that's kind of and investors, they also look at the performance. So when they're getting good performance, some of our best advocates are other investors. So they tell their friends about, hey, I invested in this fund or ETF, and look what's happened to my performance, and I'm very happy about it. So word of mouth has been a huge way that Vanguard has managed to kind of sell over the years. You probably noticed we don't do a ton of advertising. We do more now than we used to do back in the day, but it's just, if you have really, investors who are happy with what you do, then they're going to tell their friends, and their friends will tell their friends. And before you know it, you have this kind of a snowball effect where, the assets really start to increase.
I feel that's like another example of the compound effect.
Yeah, absolutely. Yeah.
So I think it goes without saying we're in a pretty exceptional economic and market environment right now. So I just want to know, where do you think ETFs are going in the future? If I'm going to play the other side here, do you think that it's a bubble? That there's a bubble with ETFs? What are your thoughts?
Yeah. So I think, the notion that ETFs are a bubble is kind of, it's a little distorting. It's rooted in a bit of a misunderstanding about ETFs. So they simply are just a basket of securities that are going to offer you exposure to different segments of the market, right? So they're not like just a monolithic structure. So rather, they're like a structure, which means you can invest in, if you want large cap exposure, you want small cap, you want high yield if you're thinking about fixed income, treasuries, international stocks. So I would say, if you think about it, less than 15% of the global equity market is indexed today. So when I think about it, that means, 85% is not indexed. So when people talk about bubbles and ETFs, I think, I don't see it, because I think so much of passive, of when you look at the market, so much of it is not passive related. So it's still in kind of, you would say, non-passive. So I don't see, I will say that from today's levels, we're pretty much at all-time highs in the market. I think the expectations maybe going forward should be a little more muted. But I heard on 60 Minutes, I watched it on Sunday, and the head of the Fed was on there, and it was asked the same question: hey, are we looking at a bubble? I think anybody who thinks that they can predict the bubble is probably not being totally honest with you. I would say, expect probably that future returns are going to be a little more muted. But in terms of calling it a bubble, there were people calling a bubble, a year or 2 years ago. So it's something that nobody, I think, can predict. So when you can't predict it, you just you put it in place. You get your asset allocation, like for your age, what is appropriate in bonds and stocks and domestic, international, and then just kind of set it and forget about it. And, trying to predict timing the market, like, even if you thought like, oh, I think the levels are really elevated right now, there's always two decisions to be made, right? If you do think you can time the market, well, maybe you get one leg of it right, so you get out at a good time. But when do you get back in again? So there are certain people who maybe they get one part of that right, but in all my years, I've yet to meet somebody who can do that well, who can time the market. So, it's not about timing the market; it's about time in the market. So I would say forget about in and out of the market and bubbles, and just put a plan in place and just block out the noise.
I love that. I absolutely love that.
Yeah. I think
and it gets so easy to get like, oh, sorry about that.
Yeah.
No, continue.
I was just saying, especially now that, I'm a little bit more new to the finance realm, but you can drown in analyst recommendations or publications or stocks and predictions and, simplifying it like that, thinking, time in the market, not time in the market.
Yeah, exactly.
Really ground.
Yeah.
So everyone has an opinion. Everyone has a thought. And everyone is telling you do this, but not this time.
Yeah. It is hard. Sometimes the best thing to do is just block all of that out, and just know in your mind what it is that you're looking for and what your what your goals are and all of that other stuff. I mean, if I think about it, we at Vanguard, it's very difficult to own an individual stock because I work on a trading desk. So we have to, go through compliance and a lot of different hurdles you have to go through before you would get the okay. So all I really own is mutual funds and ETFs. And I can't tell you, like, the number of times over the years where I, thought, like, back in 2000 when I was like, oh, man, I wish we could buy stock because I would have bought this stock or that stock. And it turned out that it was the best thing ever that I was not able to buy individual stocks because it was, I would have got run over. Some of the stocks that I loved are no longer even stocks today. They've gone out of business. So mutual funds, ETFs are a great way to invest. And I think you really need to kind of block out a lot of the noise that you hear and just know that, people are paid for their opinions. So just know that that's kind of what's going on, right?
Yeah, that's such a great quote. Love that quote. So to anyone who's beginning to get into investing and just wants to, dip their toe in the water, what advice would you give them? Or if your children were to ask you today, like how would they start? Like how could they start investing? What advice would you give them?
So I would, I think I mentioned a little earlier, I would say, the most important thing is to just get started. Like you have people who are just always like, well, I'm going to wait until the market sells off a little bit and then I'm going to get in. Just, dip your toe in the water. Just start, even if it's just the minimum to get into a mutual fund, just start investing. And then obviously, I'm probably a little biased because I work at Vanguard and just try and educate yourself about, some of the basics of investing in terms of what role costs play in the equation. So, and understanding low cost passive investing, diversified funds, it's not incredibly glamorous, but it is a great way to save. And, if you can start out as a teenager, 20, 30 years from now, you'd be amazed, even a little investment. If you look at that and how it compounds over time, especially if you can add to it, as you move through kind of the different stages of life when you get, summer jobs in college and then maybe you start your first job. And as you can kind of add to that, that can add up to some huge money down the roads. So I would say just, make this, pull the trigger, avoid I would say, I wouldn't be a fan of, looking for individual stocks at a young age. I would look for low-cost diversified funds when I'm starting out. And then maybe down the road, if you feel like, hey, I still have this additional money and I really like this company, I've done my research, maybe that's okay. But I would say as a core holding, I would look at having a diversified low-cost approach.
Definitely.
Yeah, that's great. That's a good point because I've done it for myself. I do a little bit of everything, trying to find my way out. But I also invest on behalf of my younger siblings who are not yet old enough to have their own accounts.
Great.
And their returns look better than mine.
That's great. That's great. Yeah.
I've done it
Yeah, I mean, it's funny. My one son, when he was in high school, it was a theoretical $10,000 that they could invest. And, the competition was over the course of the semester, so a little short in terms of time frame. But my son Jack, he decided that he was going to take a portion of his $10,000 and invest it in Tesla stock at the time. And this is going back a few years ago. So every now and again, he'll tell me, "Hey, Dad, that Tesla investment, if I had made it, it would be worth this today." So it was a good kind of a lesson, I think, just in terms of how if you can just put a small amount and you do happen to get lucky. But I've been trying to coach him that, hey, you got lucky with that. You really ought to be thinking about a more diversified kind of mind frame, looking at low cost investments. So I think I've convinced them that maybe the VTI might be the way to go going forward.
Yeah.
Totally. So for our readers out here, I'd love to know if you have any book recommendations. I know it could be about investing, could be just a great little fiction book you read.
Yeah, I mean, I just finished reading a book. It was called Endurance. I don't know if you've read it on Shackleton to the Antarctica, the South Pole. Just a phenomenal book on just leadership. If you think of it, this is kind of back in the early 1900s. Just boats were not what they are today, and these guys, basically were going to try and be the first to make it to the South Pole. And just the way that 27 men on a boat that got stuck in the ice and then had to cross over 850 miles across ocean and ice, and how they just made it, and just the challenges they had, and just lots of lessons, I think, just to be as someone who's working with teams in terms of how you interact with each other, and creating an environment where these guys knew that they had a mission and resources. And even when things got really bad, like when they were totally soaked and freezing and conditions were really harsh, how they hung in there together. Lots of lessons, I think, that anyone can pick up from going through that type of an experience. And then in terms of just trading, I would see Flash Boys was a book that came out a few years ago that we actually knew a couple of the guys that were involved in it, Brad and Ronan, and just a good insight into kind of what goes on in market structure in the U.S. And that was an enjoyable read as well. So those are two books that come to mind. Obviously, Mr. Bogle has plenty of books on the advantages of indexes over the years, common sense on mutual funds and common sense on investing that are very good. And our former chairman, Jack Brennan, actually is coming out with a new book next month on investing, that I think would be worth taking a look at as well. So lots of good books out there. The thing about what I do is that there's so much. I'm surrounded by so much information every day between 4 terminals around me and Bloomberg's and articles from researchers, and it's sometimes nice just to get away with a book, to get away from it. But there's no shortage of great material out there right now.
Yeah, definitely. Yeah. Well, thank you so much for your time, Mr. O'Reilly. We greatly appreciate you coming and just speaking to us. This is really an honor.
You're very, very welcome. I mean, it was great. I did the conference you guys had a few weeks back. It was great to be a part of that. And I would say, some fantastic questions here today. And happy to answer any questions you guys might have. Just fire me an email or whatever. But really enjoyed interacting with you both, and wish you both well the rest of your college career. And who knows, down the road we may see each other in the business world, maybe even at Vanguard.
great. Thank you. And a lot of great.
You're very welcome.